We're not recording yet. Where are we? So, yes, we are. Okay, well, welcome everybody. So you can see the main screen. Can you see the whole lot? The slideshow. Right. So this is the idea of this is for the forecasting and business planning workshop. Is I've been working with Steve and Mark as on a far wider suite of software as part of our developing our virtual finance director service. And one of the things we were talking about is the forecasting for the finance for the epidemic, the pandemic, and the CBILS loans, and obviously the bounce back loans, etc. One of the bits of feedback that we're getting from our banking colleagues is that the lack of detail that was being presented in their applications. And what Mark and Steve is proposed was this model should be made available free to our clients and attendees of this workshop. So this is an integrated 5-year plan that has a forecast, but also has an ability to create a proposal tool to put in front of funders. So that's all been thrown in as part of the participation with this. So let me warn you in advance, you know, quite a few accountants. Actually, one of the things I should have done was mute everybody. So, right, so just mute everybody. So that way there's interference. So if there's anybody coming in the office talking, that's fine. You can carry on doing so. So what we're trying to do is actually make it easy for everybody to actually have benefits from this tool. But one of the issues is it is pretty complicated. So although it is a very, everybody who's used to Excel will find it a simple spreadsheet like anything. When you look at it, it's not your model, it's quite complicated. So I'll go through that. So let me just take you through what we're doing. I'm sort of thinking, I took this picture up on the Downs in Eastbourne, believe it or not, it looks like the Serengeti Plains, but it's thinking about what's the new normal. So like the gold of yesterday, is it still going to be there? And I suspect not. I hate thinking I'm negative because I always believe I'm one of the most positive people, always looking for the opportunities in every situation. But I'm astonished by the number of people in business who think that there's just going to be an automatic bounce back and that we're going to be back within a few months to where we were. I just suspect that that's not going to happen. I think that I hope we're not going to be in for a recession like the 30s recession, or even indeed the recession of 10 years ago. But I think we are in for a big problem, and I don't think the mess has even started yet. So what we're going to need to do as a result of that is probably go to the banks and ask for more money. And the evidence so far is people aren't asking for a lot of money, and they might not get it if they leave it too late. So that's hence the reason why we're trying to look at this and say, don't assume that the gold is going to be there. What's the new dawn in your life? Is it going to be really difficult? Is it going to be tough? The whole point is, unless you can actually show you've thought through it, you have no credibility, because anybody can come up with any figures, but you've just got to be able to demonstrate in terms of rationale that you have thought it through, and you can demonstrate the reason why that you've come up with the figures that you are presenting. Just got Paul coming back in and just come back on into the model. So what we're trying to do is give you the opportunity to prepare your own model. Now, if you're already on Xero, we can pre-populate the model for you with your history. We're going to use a model that is a model that we call the universal model that assumes that you aren't on Xero. And I know, Michael, for example, you're not on Xero. If you were to use this model, you'd have to cut and paste the information from your spreadsheets into here, or you can just manually put it in there. So this software is going to be integrating with Sage by June and with QuickBooks Online by the end of July. So it'll make life a lot easier when that happens. So the new dawn, who knows what it's going to be like? All we know is that it's probably going to be tough. So as a result of this workshop, by the end you'll know about how you can create a 5-year plan and workshop and produce a funding proposal to support your claim if you need it. What we're going to promise is that we're going to just show you how, and I'm going to be a living example because this is the first time I've presented it, how easy or how difficult it is at times, but we'll have Mark ready to jump in and help, and Steve as well. And also, if you, we'll give you the report generator, and at the end, we might also give you some freebies in terms of utility tracking cost-saving tools. So that's one of the areas that we'll look at. So here's our agenda. We're going to establish the history. So if you're on Xero, you can download it automatically as part of this software. We'll do it for you. If you're not, what we'll have to do is show you how to load your historic data, establish your baseline forecast to create a profit and loss account, establish a cash flow and balance sheet assumptions, and then we'll show you how to come up with funding forecasts to reflect the impact of your existing forecasts as a result of the COVID pandemic. And then at the end, we will actually create the fund generation tool. Normally at this stage, Mark will jump in. I will stop sharing my screen and he would take over. But Mark has agreed, just so as part of the exercise to demonstrate what we're trying to achieve, I'll present it there, and I will stop sharing this screen and load up a new screen. So bear with me while I do that. You can tell this is live. And I will load my Excel sheet, and let's stop sharing that one. Go back. Mark, we'll have to work out how we do that seamlessly in future. So I'll share a new screen now with, hopefully. Can you all see that model now? Right, brilliant. So this is the model that a demonstration version with Demo Company Limited, and it's a whole load of tabs here at the bottom that you're going to see. So the first tab is the process tab, which basically is, these are the instructions. So if you got this model, and everybody attending this course is going to get a free copy of this, you'll look at the process saying, where do I start? Well, you actually have a look at this, and it will just take you through what you have to do in all your different tabs. What are the issues? And I'll explain. There's lots of explanatory cells in there as well. There's the closing balance sheet tab, the baseline forecast, sales forecast, etc., etc. So I'm not going to go through all this because we'll cover it as we go through. The next tab, we've got two grey tabs: sample profit and loss, sample balance sheet. This is just to give you an example of what your history will look like if you had your information loaded. So you'll have it's basically taken from your software, your sales by the different nominal types, your cost of sales by your different nominal types, and your overheads in the different versions. So a very normal basis, but split by month. When we move to the sample balance sheet, it's just one column, and you've got your nothing unusual there, your fixed assets, your current liabilities, your long-term liabilities, and your equity. Right, so you can't do anything with that because you can't mess around. It's just there for demonstration purposes. If you try and mess around with it, you'll get a thing saying you can't work on this. This is your monthly profit and loss. Now, this is where your history, when your history gets loaded, it gets loaded onto here. So you basically you put a name in here. So it's called Demo Company, but you'd put your name into this cell. And you see here these little red triangles at the end of cell. That always means there's a comment on there. So it says, please enter the name of the company the forecast is being prepared for. The name will appear on all the reports. So all the subsequent tabs come back to this cell to load the reports. If for example, you were loading the information from May, you would just change here and type in May, and you'll notice where February is the next one, it will change to April. So it just allows you, so it's an automatic there. I'll turn that back to where it was. When you're setting it up, you look at this structure and you'll see sales nominal 1. Now, the importance I need to make you aware of is you can see here, select category. This has already been pre-prepared to make it quicker in the presentation for you. So if we put here sales, you've got, you'll see if there's a drop down, all your categories are either going to be sales, they're going to be cost of sales, or they're going to be overheads. So if you go and put that cost of sales, it will appear later on as a cost of sale. Your figures will look stupid, but it will appear as a cost of sale. But you know, clearly that gives you the choice. Now, any nominal ledger line has to be allocated to either sales, cost of sales, I'll take it back to sales, or an overhead. If it's a total line, like here, total sales or total sales here, just use it as select category. So it won't be sales, cost of sales or overhead, it'll just be under select category. And that way it won't appear in the report, because what the report is looking for is something that either has called sales, it's called cost of sales, or it's called overheads. So it will pick up any information and any description. You can go in there and call it sales, whatever, sales type 2. Whatever you want to put in there, it would, whatever appears on your nominal ledger screen, you make it yours by typing in there. Again, just for this exercise, I'm just going to go back to where it was because it's just been pre-populated. The same with cost of sales. So if you've got, like Michael, as a lawyer, you're going to have your conveyancing department, you're going to have your probate department, you're going to have your family law department, etc. You would have your sales broken down in those categories if your nominal ledger in your trial balance gives that information. The same with your cost of sales, you break it down, whatever is relevant. So it mirrors whatever's in your accounts. And again here, your cost of sales category, the total and the description is just called select category, but you've got to say these nominal accounts have got to be in cost of sales or overhead or sales. So total cost of sales is select category, overheads are broken down, and they're all described as overheads. So these are just the descriptions that are put in, and all the information, the history, has been pre-populated for you. So that's all taken in. You have to, in your case, if you haven't got it pre-populated because it's not on Xero, on Sage or on QuickBooks, you'd have to manually go and put it in either through cut and paste and put it in there. And just enter the information in for you month by month to have the history, because the history is important. This model can load up to 5 years worth of history, and it's really important from the reporting and again your credibility. The more information you've got, the more relevant it is to you when you are presenting a proposal to your owners, to your shareholders, to your colleagues, or to the funders, whoever you're preparing the report for. Okay, so that's the monthly P&L. Closing, if we look at the next tab, we look at the closing balance sheet. And again, it's a column that we're looking at the title there. They're either going to be fixed assets, they're going to be current assets, they're going to be current liabilities, long-term liabilities. So if I just give you a choice there and look at the drop down, you'll see fixed assets, current liabilities, long-term liabilities, or shareholders' equity. It's got to be one of those. Now, one oddity, obviously, in a balance sheet, you might have something, say, for example, a bank balance that might be an overdraft. It might be a credit balance, it might be an overdraft. So if we've got a figure that is a bank, let me see, PayPal account, or no, here we are, bank account. That bank account at the moment is a current asset, but say it was an overdraft, you could just go in there and say, right, I'd love to have a current balance in my account, but generally it's a current liability. So I categorize that as a current liability, and in the reporting, it will then turn up in the current liabilities section. So this is just preparing your model. So this is just getting you ready so that the reporting works for you. Again, let me just reverse that. So it's not a current liability, it goes back to current assets. Hopefully, that just gives you a feel for what the model is trying to do. You then load the opening balances into, this is your latest opening balance, or the last month's closing balance of your balance sheet that you go in there. And again, if it was on 0, that would already be pre-populated for you. If it's not on 0, you'd have to enter that to make sure your balance sheet balances and it ties in with the model that you've got on your own accounts. All this is done to be able to start working on the next tab, which is your baseline forecast. Now, your baseline forecast takes all your information and presents it to you as a bit of a report, and then allows you to start working on it. So if we put in different descriptions, it would appear here. So if we had taken out and called that and got select category, that wouldn't have appeared. So if I just show you what I mean by that, if I went into sales nominal 1 and didn't call that sales, I just called it select category. When I go back into the baseline forecast, sales nominal 1 has disappeared. So that's why it's important just so we get the thing right on there. So I'll just reverse that back to sales and we'll go back to our baseline forecast thing. So these are, having done your preparation, this will now feed its way through to every page in your model. So now from your pre-population that you've put in these 2 tabs, your monthly profit and loss, you will now be able to start preparing your baseline forecast. So all the history that you have put in this case from 2018, is summarized for you. So we see it there, and it says, like, this year, these sales, 215,081. Last year was 204,000, and there's a 5% increase. You will find this, because this has been a made-up example, this is a perfect business. It's got 5% increase year on year, and funny enough, each quarter it also has a 5% increase. So, but in reality, it will be different. So whatever is happening in your business will reflect itself in these figures. So this is like your reporting function, and the same with the cost of sales. You'll see all your history there. This year, these are the figures. Your cost of sales is 264,000, made up of those figures. Last year, LY, 264,000, 0% increase. The gross margin is these figures. These are the gross margin percentages that are in there, reflected just based on your actual history, and these are your overheads. So these are the history, nothing, so this is just for you, for information and also for the reporting. Now we come into where you start doing some work. So this is an example for a COVID affected business, for example. So here we've assumed that lockdown applied in March, and so April, May, June, July, no business at all. So sales have just been totally disappeared. If you said, well, no, actually, we're going to be all right. We've got, and I have got some businesses where they're going through record performance. So I mean, it's just astonishing. But say we actually said, no, actually, we're going to have a 6% increase on what we achieved last year. We'll put that in. We'll put those figures in there, and you'll find that the figures will change. So whatever. Why has that not changed, Mark?
Because you've already put your overriding assumption into the sales.
Okay. So if I just revert. So right. So at what stage? Where did I put my overriding assumption? I thought I was.
Yeah, it's just because you use the pre-populated version.
Okay. Fine.
Yeah, that's why, because you've used the pre-populated version.
Okay. Now you'll see all these things. You can just put in your own figures. So these are 0, and you put in whatever figures that you are going to be. So if you say, right, no, my figure is going to be different. I'm actually having nothing in April, but in May I started getting a few sales. On a previous workshop, we had somebody who was a restaurant, and they were doing deliveries, for example. So their sales didn't totally die out. We can put in the figures. It's just like any spreadsheet, and it just reflects itself into the totals there. And if you want to, you can then go and change your figures. You can put figures into this area, or you can just change all your figures here, and they'll just reflect in the total. So these are the year-on-year percentage increase. And then you've got the next year, you say, right, year 2, it's all working on the history that you've got. What percentage am I expecting any increase? So if I'm saying, well, actually, it's going to be picking up now, I could either choose to put actual figures in that I put round pound figures, and I put them actually in my model. So I could say, no, that's too ambitious for April. I'm only going to get 5,000 in April. Or I can just say, I can work on a general percentage. So if I just say, right, let's put that in there, leave it as it is, but I will put a 6% increase in there. That hasn't changed.
Again, it's because you're using the pre-populated model. If you change that percent, it will work for the months further out, but you've already keyed in your.
Okay, fine. So I told you it was a live thing, and this is why, seeing it from my point of view, when the first time I've actually used this model, so you can see where I've watched Mark present this for 4 times now. So these are the points where on a pre-populated model, it's already got the assumptions in there. So, but you can go in and make those changes for yourself. If you've got new business, so these are taken from your existing nominal, but say for example, you've got a restaurant business, and you say, right, now I'm going to introduce some deliveries. I'm going to introduce some outside events where they're going to have social distancing, and I'm going to be putting in social distancing barbecues in the park. I can create some new categories here and sort of say, right, social distancing events. You can tell I'm not a very good typist, but you've got social distancing events, and I can just go and say, right, I'm going to do that from June when the better weather is appearing, and I'm going to start off with £5,000, and in August I'm going to have a really good one, and I'm going to get 7,500. So you just make the model yours. So it's just literally, you can go through and add any different types of income in there that you want to. Again, I'll just take it out, my nonsense, take out my typing. Cost of sales, exactly the same way. We've changed this model this week now to give a bit more flexibility, partially because there's some miserable devils like me who sort of are always looking for a bit more flexibility. Previously, we worked on just a general percentage, gross profit percentage on sales. And I said, well, some clients will know that they've got different streams of activity and they've got different margins. So I've got quite a few clients in the hospitality world. Say, for example, they will charge for cocktails and canapes at a much higher margin than they will charge for dinners. So it's all involving food, but it's different types of food and they're different types of margins. And they might want to have, as sales type 1, cocktails and canapes. Sales type 2 might be dinners, and they'll have different margins. They might want to actually forecast the profit that they're going to make. So this allows you, at the moment, you've got a cost of sales percentage that works on your total sales figure. But you can make it, if you just change it, to work on your sales figure for nominal line 1, if that's what's relevant to you. So it's totally flexible to give you your cost of sales. In this example, we'll just take the total cost of sales, and you've got your gross profit margins in there, and you've got your gross margins shown that are there. You can change it to be whatever you want, as I say. Keep going, there's your year 2, and then year 3, 4, and 5 is just done in total. So again, these figures are calculated in there. If you want to make it, overwrite that calculation and say, no, with my 5% increase, I'm going to be far better off there. That changes to 130,000. Sales nominal ledger 9.2, I'm going to have a 10% increase on that because I'm going to be really working on the marketing, and the figures change. Alternatively, you just go in there and you alter your figures and say, you know, sales line 2, that's far too ridiculous. I'm going to get 200,000 out of that year. And you just put those figures in there. And you'll notice that the 5% there and the 5% there has worked on the new figures that we've been put in there, because they base on your sample, just like you would do if you were doing any forecast. But year 3, 4, and 5, instead of forecasting it monthly, it's just done in total. I hope that makes sense. Is then everybody okay understanding it?
I just wanted to ask, when you put in the percentage, it calculated it for you. Yes. But when you put in the amount, the percent didn't change? So no. Does it doesn't recalculate what that is in a percentage when you manually enter it in?
The percentage, where you go in there first, you do that if you want to have an effect on the overall line, but you can just, if you then go and override and put a total figure, it doesn't go and recalculate the percentage.
Okay, all right, thanks.
So if you're going to recalculate the total figure, you just leave the percentage as it is. So I'll just go back, put everything back to where it was. Okay. So same with the cost of sales. Oh, one more thing, VAT. So we've changed the model again. We've now added each line, we've added a VAT percentage, because some people will be having a percentage of their sales will be exported, will be 0 rated. So you might have a line of sales nominal ledger line 1 might be your exports, and they might be 0 rated. So what we've done is allowed for different percentage rates on there. Most cases, it's just going to be 20%. Some of it could be exempt. This model now allows you that flexibility. Similarly, with your cost of sales, if there's any suppliers which are 0 rated, exempt, it allows you to put the figures in there. And similarly with the overheads. So the model will then work out your VAT liability based on what you've put in there. So you'll see here 0%, 20%, 20%, 5%. So for example, power, electricity, you might have 5%, heat and light there. So the flexibility is yours. You put in the correct figure for your VAT, and later on in the model, you'll see the VAT being worked out for you. So at this stage, all you're doing is putting in your figures that are worked on your history. So if I was to go there, I put in all my figures there, the formula, and you'll see it goes back to July in your history and just applies the percentage increase. So it will assume, unless you've actually said there's going to be an increase, it will assume the figures are going to be the same. So it's all based on your history. That's how all good forecasts start. If you say, well, let's assume it's going to be the same as otherwise you've got to be a brain scientist to actually try and figure out the future. But if you want to change your percentages, you can do so. And so this one is a pre-populated model just to make it easier to present to you. Bad debt. If you want to have a bad debt line, you've got to use this bad debt line that's presented for you. The reason for that, so if we look at the explanation, hover over there.
If you just hit right on your keyboard, Mike, it's just because of where the panes have been freezed.
Okay.
You have to go right back to the start of the sheet.
Okay.
There you go. Now you're able to do it.
Thank you. I thought it was something to be me using a Mac.
No.
Right. So if you want to forecast bad debts, please use that row provided, because bad debts then coordinated with the balance sheet. So bad debt, taxation, and interest have got pre-designated lines because they are coordinated with the balance sheet. So when we come onto that, so anything else you put in there. So interest, use the line that's provided. It's a specific line that's provided there. And if you've got some new overheads that you're going to be incurring as a result of your new business, for example, I said barbecue in the park, social distancing, barbecue in the park, there's going to be new costs that you would then put in there. So it might be stewards to make sure people are social distancing in accordance with the rules, or whatever it's going to be. And this, you just put them in these new lines here. Then you come to, this will then provide you your net profit figure and your net profit percentages for all the months that you're working. So this is just providing your base for your forecasting that allows you to make assumptions and to test. So we will then go on to the baseline balance sheet. These are taken from the figures that you've already put in when you looked at your closing balance sheet here. And we've got our bank balance. If I'd said that bank account was a current liability, it would have suddenly appear over here. But I changed it back to showing it was a current asset rather than a current liability. So this figure now agrees with your opening, your balance sheet that you've put in there. So you've got your current assets, you've got your current liabilities, you've got your long-term liabilities, and those will appear there for you, okay? There's your baseline balance sheet, and then the real thing that you've come for is your baseline three-way forecast. So this has taken the information that you've got in your history and taken all that information that you've put in your forecasts, showing the percentages, showing your overheads, your balance sheet there, but the blue lines are asking you for some input. So they're saying, right, depreciation, this is from the history, your average depreciation rate is worked out at 32%. Now, if it's going to be different, you know something's different, it's going to go down to 25%, you just go in there and change it to 25%. And the figures will change for you. So it's looking for an input. For interest, we had an opening debt. So when we go back to our balance sheet, our baseline balance sheet, we had a 5,000 bank loan. So they're looking for the interest on that 5,000 bank loan. So go back to our three-way forecast, and they're looking for that interest 7.9%. And you'll notice that we've got down here, the debt is going to be repaid in 2 months. So if that's going to happen, there's not going to be any interest after month 2. So you'll see all the interest disappears after month 2, because we've got the debt is going to be repaid. The 5,000 debt that's there in the balance sheet is going to be repaid over the first 2 months of the year. We'll come back to accounts receivable and we'll come back to accounts payable. But inventory days is also something. Now, in most businesses, I find most people haven't got a clue what their inventory days are, unless you are highly sophisticated and you've got detailed stock control. You tend to be working on assumptions that your stock is going to remain reasonably constant unless you've deliberately, say, for example, pre a sale, pre a summer season or winter season or whatever, and you've built up your stock. But this allows you to change your number of days stock that you're holding at any time. So it allows you to go in and reflect that. So if you know you've been in your business, you are buying more and you've reflected that in your costs, well, it's going to show your figures as a cost unless you actually increase your stock that you're holding and then get some credit for that stock holding. So that allows you to go in and change that. So these figures are here appearing in your balance sheet, and they'll work it out for you. So you'll see the stock has stayed pretty constant, and then when you've got transactions, it changes because there has been no sales activity in the or purchase activity in the first 4 months of the year until July, because everything died. Does that make sense? I told you it's logical, but it's overwhelming, and I've got to go through it, present it. You'll have a recording of this, and you'll be able to play with it to see. You can't do any damage to the forecast because you can always reverse something to play with it. So, having worked on this baseline three-way forecast, so let's just move that over. you'll see now that we go down to the bottom, we've got VAT. Now, you have to choose if you are taking advantage of the government deferral. You can choose not to make any payments on your VAT. So at the moment, it's assuming in this particular one, it's got a cycle with quarter ends in January, April, July, and October. So if we clicked on that, you've got the drop down. You just choose which is your cycle that's relevant to your business. So let's leave it as January, July, October. Now, if the April quarter is paid in May, if you were not intending to make that payment, you just take it out and just put there 0. And the totals will just adjust themselves for you. They'll automatically. So if you choosing to defer, I'll leave it that you're not. You've actually got enough cash that's available to you. Your accounts receivables. As a result of the position, I say I've got a few clients where the money's coming in like nobody's business, but in most cases, everybody is really short of cash. So this model now is reflecting the fact that only 15% of their balances are going to be paid in the early months because everybody's feeling feeling tight. So they're assuming your customers are going to be in the same position and they're going to be really tight in terms of paying you. So they're not going to assume a bullish position in terms of you receiving your money. So you've got to choose to whatever profile is appropriate for your business. So if you think you're going to get 50% of your debts paid, just type in 50% and it will affect the figures. And it might be because you're having some sort of initiative to try and get debts in. But again, let me just change that back to put the figures that were already in the pre-populated. You choose whatever's relevant. But if you were going through to year 2, it might pick up. Now, what we've done is we've assumed it's going to be picking up, so 50% of your income. But it might be that you've changed everybody onto direct debit. You're going to take far more control. So actually 50% is too low. I'm going to go to 65%. I'm going to go to 65% up there. I'm going to go to 65% up there. And the balances are adjusted in accordingly. So your cash coming in is reflected that in accordance with whatever you have chosen to put in there. You don't know. You've just got to make assumptions based on what you know your strategy is likely to be, based on, like, for the first year, things are going to be tough. It might not be as tough as you can, but you just have to make those assumptions. What I said to you early on, the banks are saying there's so little information that's been given to them. The more credibility you will show by showing these are the assumptions, you know, whether you're right or wrong, at least you've thought it through. And this model allows you to demonstrate how much you have thought about presenting the figures. Same with accounts payable. So there's going to be a certain number of your bills that you're going to be paying. You're going to find it really tough with no trade for the first 4 months, but there's certain ones that you're paying on direct debit, certain suppliers who will not accept you not paying them. So we've put in there, let's assume 25% of your bills are going to be paid. That could be 0, it could be 50, whatever figure is right. So you choose. So if I wanted to change June to 40%, if you look at the figures, they will automatically change. So that figure has reduced because I've actually paid more on there. So if I go and just reverse that back to normal, if you look at the closing balance figure down here, 36,509, it'll change back because I've reduced the amount I'm paying over to my suppliers. And that's the same as you go through year 2, through each month, and then the figures on year 3, 4, and 5. You have to make these assumptions, whether your assumptions are right or wrong, make them and then have a look to see what impact it has on your balance sheet. Because the whole idea is, what if? You've got to plan, what if? What if the world goes into a 30-star recession? What if we don't get the bounce back that everybody's hoping for? You can play with these. You can actually have a different version of the model if you want. Save one and have another one and come up with a different version. Take a copy and have a different version. but you've got to make an assumption. And so when you're presenting your figures, and you can actually record, these are the assumptions I've used in terms of how my creditors are going to be paid, how my debtors are going, how much time they're going to take to pay me, and my stock levels. So these will, as a result of the assumptions you've made, these will actually find their way through into the balance sheet and the cash flow. So all these figures are altered to reflect what you've put down at the bottom with your assumptions. So the blue bit's there. So what else have we missed? We've missed dividends. Now that's really important. Obviously, owners are expecting to see themselves paid now. Assume the dividends here are going to be very low, but maybe in year 2 it's going to pick up. Whatever the figure applies to you, it will pick up there. Okay, and then maybe picking up year 3, 4, and 5. So those figures will then reflect that what goes through and will show themselves in the balance sheet. Taxation. We had an opening liability of 15,000. Let's assume it's going to be paid 9 months later. So our year end was March. So we've got a 15,000 liability in December. Now, it might well be that we know as a result of a loss that we're not going to be paying that tax, or we're deferring the payment. We can just put that down to 0. We look at the profits we're going to be making. So these figures are showing you here that you've got a loss of 123,000. So you can have no tax to pay in year 2. So we've got nothing that we need to put in there. These figures here are showing that year 2, we're going to make a profit of 158,000. So if we calculate a figure of 20% of that, and we could put it in 9 months later, and similarly year 3, 4, and 5. So whatever the assumptions for you, put in the figures for the tax that you're going to be paying up here. The only other bits there is equity. If you're going to raise some capital, say for example, instead of going to the bank, you're going to go to shareholders, you're going to go to new shareholders to raise equity, then this allows you to actually reflect the funding that could go in there. So that's your baseline 3-way forecast. That's where you are. You now then say, right, let's look at the blue tabs, and you're going to look at a funding forecast and the funding 3-way forecast. Now, the funding forecast is really, if you borrowed money, for example, and it was going to affect your trading because you were going to, for example, buy new equipment, and that new equipment was going to make you more efficient. So as a result of buying that new equipment, your margins were going to increase and your sales were also going to increase. You would go back and alter your funding forecast, which is exactly the same as the baseline forecast that we're looking at. But what it's now going to show is as a result of funding, what impact you're going to have on there, and you would go and change those figures as appropriate. I'm going to assume that we're not going to have anything that impacts on our sales. What I want to do is work out what cash do I need as a result of being hit by the pandemic. So I've got to look at what is it showing me as a result of my figures here. So my funding 3-way forecast, I've got my profit and loss here. I've got my balance sheet. So let's look at my cash situation. So my cash situation has stayed reasonably stable, actually.
Because you've already got the loan in there, Mike. If you go,
sorry,
you've already got the loan in. That's why it's looking good.
Oh, that's right.
If you just take that 200,000 out, you'll see.
I can be clever and say, right, okay. So we put in a 200,000 figure in there in the pre-populated one, but let's just say, right, we haven't decided where our figures, what the figures are going to be like. As a result of that, because of that, taking that money out, as a result of the hit on the sales, you'll see our cash position has got getting worse and worse in the year 1, because we've said our debtors not only have our sales dropped off the cliff, our debtors are taking longer to pay us, and even though we're taking longer to pay our suppliers, we've got a deficit in funds. And it just gets worse and worse, but it gets better until October in year 2. Then you see it's obviously a seasonal business, and we're showing the effects of the seasonality, and we've got a further position there. Let's look into where we are. 129 is the worst position, and then nothing that we put in year 3, 4, and 5 has changed that. So because we're reflecting, we hope, a more optimistic outlook for our business. So we need to find a figure of at least 122,000 in this example. Now, previously when we worked on that, we said, right, okay, we could either work 122, we'd put in a figure there of 200,000, but just say I need from the bank 160,000. So 160,000, what impact would that have on my cash flow? Right, so I'm now going to say I have the cash injected in me, and I'm going to go down 32,000, 24,000, 30,000, 37. So the worst that's going to happen, so I've allowed a bit of contingency there. So it's 128, so I've allowed about 30 grand, 32 grand's worth of contingency in my figures. So I've got my COVID impact is 128, and my contingency is 32,000. So I put in 160. Whatever figure is relevant to you, don't make the mistake that we all know of asking for too little, because the banks hate it when you ask for one figure and then come back and say, you know, I want some more. Sorry, I got my figures wrong. This whole model, sharing it with you, is to allow it to be show you a bit more credibility. So if we're happy with that figure, we just check all our balance sheets. Is there anything in there that is wrong? It's reflecting our dividend payments that we put in there. Sarah, are you trying to wave at me, or just having a stretch? That's okay. I just saw that. Now, having got that for me, if you're happy, this is where the sexy bit of the model creeps in. So we can put it whatever figures in. We've established our base. So we've gone back there. We've established our baseline forecast. We've established our baseline balance sheet. We played along with our baseline 3-way forecast. We then moved on to our blue tabs with our funding forecast, and we said, right, let's just show our funds that we've got. I've taken out 200,000 was in there before, I've just moved it to 160. So these are my figures, and then what I do is I press that button, and it will produce me a report that I can't show on this. It's not working.
Yeah, Mike, I've just realised you're not using the one that we did for Mac. So if you stop sharing your screen, right? I've already got the model up because I kind of anticipated this would happen.
Brilliant.
A while ago. So, do you want to talk through this bit, or do you want me to carry on?
You carry on. That's fine.
I'm happy. So literally everything else is exactly the same as Mike's. Apart
from you've got 200,000.
Apart from I've got 200,000 in my model, except for the 160 that Mike put in. So the purpose of everything that's been done so far is, right, I've gone through a very, very methodical exercise where I've understood exactly what's happening in my business. I've understood exactly what's going to happen in my business, and I've understood that there's going to be a pinch point. I need an amount of money, and that amount in this example is 200,000. Now, what you can't do is you can't send loads of tabs, loads of pages to a lender and go, there you go. Really what they want is that in a nice, concise document. So what we produced is a funding proposal, and we've run this past a few lenders, and it's, I think the words out of someone from Metro Bank on the call last week was that's exactly what we ask our execs to do when they're looking at lending proposals. So essentially what we've created is a document that you can just hand over with your proposal. So all you do is you click generate proposal. That will then if you're on anything other than Mac, that will then just ask you to save the file somewhere. So I'll save that file, and what it is doing now is it's going through the process of just looking at all of those various tabs of information, and it's just pulling it all together in one document. And it will, once it's pulled that together, you'll get a dialog box which will tell you that it's finished, like that. And then what you do is you go to the location that you've saved that document, and you open that document up. When you open that document up, it will look like the screen in front of you. So I'll just show you how this prints out, because you've got lots of sections in this report. Everything that can be pre-populated is already pre-populated, i.e. anything this is numerical. So all of the numbers, all of the graphs, everything like that has been pulled through from your model. There is a little bit left for you to do though, because what lenders do, they don't just look at your numbers, they follow a methodology called CAMPARI, which I can't remember what the individual letters stand for, but essentially it's a test that they apply to proposals, which basically says, do you actually know what you're talking about within this proposal? So yes, I understand the numbers are there, but do you understand why the numbers are the numbers? So if you look at this document is a 6-page document. So everything that is within your model has just automatically been pulled through to a proposal document. And you'll see that there are some elements of the document that have been pre-populated and some elements that are there for you to populate. And the bits that you need to populate essentially are about your business and about any assumptions you've applied. So we go from top to bottom, start off with my exec summary. And if you look at that and go, well, what do you mean exec summary? What do I have to include in my exec summary? Well, a tooltip next to every box to explain exactly what the lenders are looking for within that section. So as an example, be brief, just how much you want, why, and what it's going to be used for. So this is just setting the scene. And there are then other elements of the form that you need to complete. So company profile. So again, we can't pull that from the accounts because you don't hold a nice concise company profile within your accounts. You'll have it somewhere, but essentially, well, okay, well, what do I need to include there? Well, just a bit about the history of the business, the sector that you operate in, who your target customer is, the overall industry, any geographical markets you might operate in. So just general profile, so the lender's got an understanding if they don't already know about your business. The financial performance will already be pulled through. So this is already populated, this commentary. If you want to keep it, you can. If you want to add to it, you can. Or if you want to put your own in, you can. You can do whatever you want, really. I'll just leave the basic. It's basic commentary, just looks at revenue and profit over the last over the last 5 years in this case. Now this is where I think Mike mentioned earlier, you can load up to 5 years worth of information into the model. So if you load 5 years, it will talk about 5 years worth of history. If you load 2 years, it will talk about 2 years. If you load 4, it will talk about 4 and display 4. So we've got some commentary there. Like I say, you can add to it if you want to. Then we've got some graphs, which is all talking about history at the moment. So we talk about the previous 5 years. We look at revenue, we look at margin, both as a cash figure and as a rate, profit, and then the net worth of the business, and then performance by month over the last 2 years. So here we've got a really, really good understanding of the business, the sectors that it operates in, and the financial performance. One last thing to include about the business is a SWOT analysis. And again, if you're unsure of what to include within the SWOT analysis, you've got the tooltip. So the tooltips are here on the screen to help you. They obviously don't appear in the report when you print it. They're omitted from the report. All you get is the information. So if I'm sure what to put in a SWOT analysis, it's there. Then I get down to the funding. So it's already pulled through from the model that I wanted 200,000. I know Mike's example was 160. I want that over. So this is over 6 years. So within the model, I'm going to take full advantage of the 6 years that I can have a CBILS loan over. Then I need to break that 200 down, and I can't remember the exact numbers in Mike's scenario, but essentially I think that was about 140, which was to mitigate a short-term cash deficit, and then I think we'll put a bit of a high contingency. You probably wouldn't get away with a 60 grand contingency, but we'll make the rest up with contingency. Things like between 5 and 10%. from our feedback from lenders is that they, that is perfectly acceptable. There are two things they really don't want, and that is you, first off, undervaluing the amount that you need, and that goes hand in hand with coming back for more money, because they would rather you ask for more, and do it once and do it right, than keep coming back, because it just shows lack of confidence. A breakdown of exactly what that's used for, and again, might use the example of you might be asking for a loan for machinery or anything like that. You just break it all down. We don't want it broken down to the each individual element, just the main categories. So up till now, we talked about the business, talked about the history, given them some comfort that actually you understand what you're talking about. And we've talked about that we need some money, and now we're just going to articulate the impact that money has on the business. In this instance, it has a very, very small impact on the P&L, i.e. the trading performance of the business, because all you're doing is adding a bit of interest on a loan. In Mike's example of some equipment to increase sales and to reduce cost of sales, it would impact more of the P&L. But essentially, you get a comment saying what impact the investment has on your trading performance, and what impact that this has on your cash position in the business. So here, our cash flow is expected to increase from, in this particular model, slightly different to Mike's one, was minus 151,000 to a low point across the entire 5 years of just £600. That's our low point. Again, I can keep that, or I can put in whatever assumptions I want to put in. I don't have to keep with those, keep with that commentary. Next, I need to just put in some forecast assumptions. So our assumptions were that we're going to do hardly anything over the next 4 months, and then we're going to have a slow build back up to normality, or whatever that normality will be going forward. So just articulate in words what assumptions you've used, so again they understand exactly what's happening, because we've gone through the history of the business. This is about understanding how we forecast the future of the business. Then we've got some graphs which show the difference between our baseline and also our with funding scenario. So again, it will show the impact on both the P&L and the balance sheet. In this instance, we're only really interested, and we only see a material impact on the balance sheet, and it's effectively we're looking at this graph here, which looks at the cash balance. In my baseline assumptions that Mike went through, we had a point where we were, at the end of year one, we would have a negative balance of 145 within our business. With funding, we now get to a point where that's actually positive 55 grand at the end of the first year. So we can see here the impact that funding has on the business, i.e. it's going to mean that we can actually trade through this crisis. And then because we've got years 2, 3, 4 and 5, you can actually see and understand that actually this business is going to get back to around about £200,000 profit, which, if we go back to the history of this business, is broadly in line with where we were or where we have been over the last 2 years. So the key thing that the lenders are looking for is, how were you performing? Were you a viable business, they call it? How will you be impacted in the short term? And will you be able to trade out of it? So that's exactly what this document is showing. It's showing that we're made about 200 grand over the last couple of years. We're going to get hit, and we're going to get hit hard over the next year. And then we're going to make a profit back to the point where we're going to make around about that £200,000 profit again going forward. And it's realistic, because we're not saying, I think a comment from one of the lenders last week is you should see the number of proposals I've received where they were making about 50 grand, and in 2 years' time they're going to make £1 million profit. So we need to be realistic. But what we've done here is we've showed all of our assumptions, and we've linked that back. And then finally, we show our next 2 years by month for revenue and also profit, just to show where we're expecting, again, to go through the really, really tough period over the next 12 months, but then we're going to trade out of it. and some commentary talking about where we're going to end up in year 5. Then if you want to add anything else, you can do in the other information section. And then finally, you've got the full detail in the appendix of your profit and loss, your balance sheet, your cash flow statement, and all of your workings as well, if they want to go into that. And then that will all print out, like we said, on 6 pages to accompany the proposal. And it's a concise document with everything that the lender needs to be able to make their decision. So I'll hand back to you now, Mike.
Okay. Thanks, Mark. So I think at that stage, what we ought to do is just unmute everybody. So if I go into participants and unmute all. So, right. So those of you who have muted yourselves, you'd have to unmute yourselves anyway. But when I first listened to Mark present this, I thought, my God, I'm an accountant, and I was just overwhelmed by figures. So even though I'm used to figures, it just sort of hit a wave of figures hitting me. But when you actually look at the model, and I say we just changed this model this week just to increase the added flexibility, because I felt uncomfortable on having general gross profit percentages and VAT percentages, having average VAT percentages. I felt uncomfortable on that. And you know what it is, some people will always find an excuse not to use something that's different. But what I love about this model is that, I mean, I've got a client with £1 million on his balance sheet. He was on this workshop a few weeks ago, and they've done their own spreadsheet, but they've got nothing coordinated. So they've got their figures, but they haven't actually coordinated with their balance sheet. And I said, but how do you know the impact on your balance sheet unless you've actually got a way of controlling the figures? And he looked at me as though I was daft. And he said, "What?" I said, I'm talking to you as an accountant, but I said, from my point of view, I said, you have to have a model that ties in together. And this integrated model not only allows you to create your baseline assumption based on your history, it then allows you to play around and just make assumptions in terms of, right, how quickly will I pick up? Will my margins change as a result of, well, we're going to have lower activity, we're going to have to charge more, we're going to have to do something. These are all assumptions you'd have to share with your lenders, with your whoever you're reporting to, and it allows you just to test that. And then finally, you press the button and say, if there's no impact of increased efficiency because of investment in machinery, so you don't have to play around with funding, three-way funding forecast, you just have to show the cash flow implications. It then produces the model where you just add a few words to record your assumptions that you've put in there in the model, and then it actually takes you for the graphs. So it's really quite impressive. I don't know what you think. Ian, as an accountant, have you got anything to?
We use Spotlight at the moment, and that's a bit more sophisticated, but that gives a more simplified overview of the profit and loss and the cash flow, actually.
Yeah.
Straight away. Yeah.
Yeah, I mean, we've been using other software. It's just trying to have something that will be pre-populated and look at it and just say, well, people are used to Excel. Just like, for example, the gross profit percentages, that allows us to play around with it. And the model is developing. Since I first saw it 6 months ago, there's been lots of changes and improvements since then, and it continues to develop. So
what's the? I mean, there's lots of numbers there for historical information. I think you said it can go back 5 years. So how does all that work? How do you get from 5 years history to the next 12 months projections?
Well, it's there in your baseline. So when we went in there, you had your baseline that recorded all your history month by month by month.
I know, yeah, but then what happens? Well,
then it's got your year-on-year change. So in this example, it's a perfect example. It just showed a change of 5% each quarter. But in reality, you're going to have some quarters there where there might be a negative adjustment. And so it will just reflect that. It will record that. And then you with the benefit of that history, we'll look at when you're trying to do your forecast, what's going to change on my figures going forward. And you literally go in and alter your figures either by putting figures in or by playing with the percentages.
Sorry, Mike, I've got a quick question regarding like it's a 5-year forecast, if you like. I mean, at the moment, with the current climate, with the coronavirus riots, etc., we don't really know where we're going to be, say, in 6 months' time, let alone 5 years' time. How do we kind of forecast for things we don't know, and especially the way things are at the moment in the world?
Yeah, I agree entirely, Mike. That's why there's only monthly for 2 years. And so you just have to record your assumptions, and nobody's going to judge you on actually getting your assumption wrong. What Mark was saying is, so the bankers are saying it's amazing where the businesses who have made 50,000 loss last year and are in 2 years' time are going to make £1 million profit. Those applications lack credibility because they're not able to show any assumptions that can be believed. So, we know we can put any figure down there, but whether or not it's achievable is something completely different.
And for example, if the government were going to change, say, the rates on electric or something, if they went up to 20%, or VAT had increased, or, national insurance contributions and PAY had increased, is there something in there where you can just kind of swap and change and move these things around?
Well, you'd have to go, and it would be a living document in that case.
Yeah.
At this stage, you can only make a presentation based on what exists now. And you would then say that we're looking for a 5% growth, a 10% growth, or we're looking for, say in your case, you could say, we're looking for conveyancing to stay steady or increase or decrease, but we're seeing far more deaths, so our probate income from people and their wills, and lots of people changing their wills as a result of the fear from probate, is going to go through the roof. And you can show you different figures that applies there. And so as long as you record your assumptions, the banks are going to say, yeah, that sounds reasonable, or it doesn't sound reasonable.
It's reasonable for the time being, yeah.
Absolutely. That's all you can do.
Yeah.
Chris, you must see it as an advisor. You must see exactly this in terms of lack of credibility or whatever.
Having spent the first sort of 6 weeks of current crisis sort of looking at CBILS applications, and the last 5 years looking at sort of grant funding applications, and that lack of credibility, whereas people not understanding how to build sort of financial forecasts and understanding what their balance sheets and their profit and loss accounts are, whereas a tool like this actually suddenly gives opportunities for companies they're not financials. That's not their strongest point. They're good at what they do, and they've never really understood how to do the financials. And this kind of gives it that opportunity. And just to add to, for Michael, as someone who has been funding and has been looking at things, we can only take what's being told at any given time. And that's where the assumptions within this tool, looking at it, they make a big difference, because when I'm looking at someone's cash flow forecast to judge whether they need money, what they need, the biggest thing for me to help understand is that assumptions of them going, actually, we expect the next year to hold steady, or we expect a 5% loss, or whatever, based on our judgment of what our business is and what we know. And without those assumptions, it's very difficult, but having those assumptions in that document just makes a world of difference.
Yeah, that's where, when Ian's comment about where does the history show, and it's shown in summary, but in the appendices, it's shown in more detail in the background. But most people just want to look at the picture, but to know that they've actually got the figures. What we don't want to do is just give them a copy of the spreadsheet, so they get totally overwhelmed by figures themselves. So the whole question of that, having that report that takes 5 years history, no more than that, or reduces it to 2 years if that's what it is, and then just allows the whoever's reading the report, because this could be applied to shareholders just looking and say, right, we're going to need to put in more money now to fund this business. How much do we believe that this is achievable or not?
It does emphasise the importance of getting your zero records correct at first time.
Oh, do you know, Ian, that is so true, and that applies to any sort of QuickBooks, Sage, whatever.
Yeah, true.
You've got clients who've got, for example, I've got a client where the sales are going through the roof. Their zero records are really quite basic because all their analysis is actually on their website software. And so from my point of view, it's very frustrating. So if we were using this with them, we would have to do manual journals to recreate the analysis in Zero that they're getting it out of their website software. But it does make it so important. Yeah.
Just on the debtor days, I'm just trying to get my head around that fraction, that how much of your debtor book will you collect? Could that be like a rolling figure all the time?
Yeah, well, if you put in, so we started to say with 15%, we just said we're assuming. So you put in, the later years they put their 50%, and in year 3, 4, and 5 said we're going to collect 100% of our debtors. But where things go tough, we're assuming they're going to take much longer to pay us, and then we ramp it up. But whatever figure you put in is reflected then in the balance. But if you want to put a figure in for bad debts, I didn't put anything in. I could have put a figure on the bad debts line, and that would also then reflect on the balance sheet. It would take it out of the debtors.
And I know a few lines below the closing balance on the debtors. There was the debtor days. Is that calculated automatically then when you've changed the percentage?
Yeah.
So, okay. So you can play with that percentage, and then that will determine your debtor days.
That's right. Well, you'd be playing with you could be looking at it. Can you play with the percentage mark? I think that's a calculation, isn't it? And it's the blue line where you make an assumption.
Yeah, essentially the debtor days is just the resulting calculation, because it's the
good. Yeah, that's good.
Yeah. Yes, it basically gives you a sense check, essentially, because in a situation like Mike's just gone through with you, your debtor days are going to, so you haven't got any revenue and hardly anyone's going to give you any cash over the next 4 months. Your debtor day calculation is going to go up something like 200 or something like that, because that will be the calculation. Is it
calculated on the actual month then?
It's basically the standard calculation where it looks at essentially a rolling year. So where am I on average over the last year?
A rolling average. Yeah. Okay.
Yeah. The key. So for business owners, the key is just the cash number. So and sense checking that cash number, and then I think for the accountants, where we kind of think about it in things like debtor days. That's more how interesting the model started off, by putting in a driver of debtor days. Yeah. And only the accountants understood it, really. When you start talking to a business owner, it's like, well, you want to talk about pound notes. At the end of the day, you want to say, right, well, roughly how much do you think you're going to generate? Because it's a lot easier to understand and comprehend. So that's where the percentage comes in, effectively. If you're an instant payments business, i.e. you take cash or card, it's 100%. Yeah. Because you're just getting everything straight away.
Yeah, I spoke to a client on Monday, and it was clear to me that he's got quite a bit of loan. He's got a few loans already, a few commitments to HP, and I'm the accountant. I said, let's just ignore HP. Let's ignore depreciation. Let's just call it loan repayments. Yeah. In your P&L, so he can actually, because he didn't have a cash flow, and that's all he needs today. It's the accountants, we just confuse people. It's terrible.
Yeah, need to simplify it.
As business owners, cash is king.
Yeah, that's why I said when you talk about your inventory days, I find, apart from the larger clients, they look at me as though, come on, we count that up at the month end if we have to, but normally at the year end, and we just get a feel. So we look what's on the racks, or we look what's on the shelves, and we get a feel for it, but we're more interested in what's in the bank. But particularly where it's seasonal, and you say, right, I'm ramping up the stock, so I'm buying more, but I don't want it shown as a as a lower gross profit percentage, I've got to reflect the increased amount of stock or work in progress I'm holding.
Yeah, just for cash flow.
Okay, well, that's not so much cash flow, because the cash flow is whatever you're buying, but for inventory days, it's more for reflecting the fact that the impact it has on the profit and loss account in terms of the gross profit percentage. Okay, so if there's no other queries, what to do is I'll see if I can come back and share my screen again. Share. Can you see, does that come up my spreadsheet, my PowerPoint?
Yes.
Yep, brilliant. Okay. So what we've done is we've produced a 5-year plan forecast, shown you that there's the report generator should you need to have it, and we are happy to introduce cost saving and opportunity analysis audit, but that's something that can follow on later. What we're going to do is put a recording of this on the website, so particularly Michael, if you wanted to have a look at it, if you or Chris, you wanted to follow, so we send you a copy of the model, then you can say, well, where does that take us? We'll send you a copy of the model, tell you this will be up by tomorrow on the website. We'll let you know that, and then clients who virtually got zero, they're lucky, because we had on the workshop last week, we had several, and they had a pre-populated model sent to them. But the challenge for us...
Got a quick question. Because that model you're sending, it does look a little bit more complicated. Can we tailor that for your own needs, or is it something you can, or even leave some of the...
It's yours, Michael, to play with, because the thing that it will give you is a totally integrated one where the balance sheet works. So you choose to use it in whichever best way suits you, and if there's any way we can help you, obviously we'll do that.
Yeah, thank you.
Okay. So, really, the challenge is for us to take action, because it's very easy to sit there and think about it but do nothing. And I do feel that there's an awful lot of people. We had our BBF, our Business Builder Forum, during the week, and we had a speaker talking about the new digital age, and he just said there's so many people just thinking that we just go back to the old normal. And he says there's no such thing as old normal. There's going to be a new normal. We just have to rechange the way we think, the way we work, and the way our clients are going to work, and what they're going to expect of us. And just thinking that we're just going to go back and same old with a few bits of fine tuning is just fooling ourselves, kidding ourselves. So that's the challenge, is to sit down and think and plan well ahead, especially where we're going to need the funds. So hope you like that. Any feedback will be very welcome. Paul Bushell came on and came off, so I don't know whether he had a problem with the signal. So, and a couple of others didn't come on. So Sarah apologised, said she had to leave for a 4 o'clock appointment, so she'll be leaving at 3:20. So apart from that, hope it works well for you. The model for you, Chris, particular, Michael, Ian's going to be playing with it. Give us some feedback and let me know what you think.
Okay,
Will
thanks,
do.
Mike.
Okay.
Thank you very much, Mike.
Thank you.
Well done.
Okay.